Additionally, like if you want to trade crypto asset like Bitcoin, Ethereum, I guess the first option is using the centralized exchange platforms like Binance, Kraken, Bittrex, Coinbase. We have kind of many kind of famous exchanges. And they are called centralized exchange because kind of everything is managed and controlled by just a single centralized authority. Okay? For example, if you're trading on Binance, maybe you have to transfer your US dollar from your bank account to the Binance account. So Binance will have custody of your fund. Or maybe like if there's some trouble, Binance has control over the transaction. So it is possible that Binance is going to suspend your transaction. So those kind of stuff will happen because we have just a single centralized authority who controls the exchange platform. In contrast, many exchange platforms has been built on smart contract of Ethereum blockchain, meaning that there is no such kind of centralized entity and everything is distributed. Okay? And of course, there are many, the centralized exchange and decentralized exchange, they are different in many aspects. But because this is a finance paper, we're going to focus on the difference in terms of the market microstructure. In particular, we're going to look at the difference in sort of the pricing algorithm, or should I say the matching algorithm and pricing algorithm. So in a traditional centralized exchange, we know that we are typically using this limit order system, right? If you go to Binance and trade, you have to deal with this kind of screen. But it's quite difficult to go back and forth on this in-person presentation. But this kind of limit order system is kind of complicated. It's kind of complicated algorithm, and you have to refresh and deal with kind of huge amount of information. So it's not really feasible on blockchain environment because blockchain has only a limited capacity, and also you have to pay kind of huge mining fees. So instead of using this limit order system, many decentralized exchange platforms are using this automated market makers. It's kind of new market making algorithm. Okay? And before I show you what they are doing, this figure plots the trading volume on decentralized exchange. And it's growing a lot since DeFi summer 2020. And also, I decompose transaction volume on trading on DX with automated market makers and those on DX with limit order system. And I think it's quite safe to say that this kind of growth is mostly driven by the automated market makers. So they're playing a very important role in the prosperity of DX. But at the same time, we know that traditional CX, centralized exchange, with limit order, like Binance and Bittrex, Coinbase, they still have kind of huge trading volume. Okay, so this implies that we have both of this kind of new market making structure, AMM, and limit order system. We don't know which one is going to dominate in the future, but at least in this kind of transition, we're going to have both. Okay. So in this paper, we provide a theoretical framework to analyze this kind of coexisting environment. We're going to have both new one and old one, and we want to know what's going to happen, how they're going to interact. And again, this is because finance paper, we introduced this asymmetric information problem. Also, traders are going to decide on the trading platform endogenous manner, and also liquidity on both exchange platforms will be endogenously and jointly different. So this is what we are doing in this paper. Okay, so let me show you very briefly what the automated market makers are. So as I said, maybe I didn't say, but automated market makers, you can think of it as the very simple pricing functions. And depending on the functional forms, we have many categories of automated market makers. But so here, I'm going to show you kind of most kind of simplest and also most widely adopted design of automated market makers, which is constant product market makers. So suppose that automated market is trading some cash and some digital token. Of course, it can be token versus token, but in order to make it kind of easy to digest, let me use cash versus token. So to begin with, liquidity providers can inject both tokens and cash into the exchange. An exchange, or maybe automated market, is going to aggregate these kind of provided assets and generate so-called liquidity pools. It's kind of reservation of the asset and cash. Okay? And once you have this kind of initial liquidity supply, then you can pin down some constant, okay, as the function, as a product of these two values of liquidity pools, because this is a constant product market makers. Sorry that we can see that. Okay. And by using this function, of course, we can draw this kind of convex curve, which we call the bonding curve. And the automated market makers require that all trade must be done along this curve. Okay. So what does it mean? If there's a liquidity taker arriving at the market saying that I want to buy delta X unit of token X by paying in cash, this guy is going to withdraw delta X unit of token X from the liquidity pool of the, token X liquidity pool, and then he's going to add cash. He's paying cash. So initially we were here, okay? But after the trade, state of the liquidity pools will be moving up toward, here. But as I said, automated market maker is gonna, require that even after the trade, liquidity pools must be on this curve, okay? And this is going to determine the price, okay? So before the trade, we had this product, okay? And after the trade, we have this product. So we got single equation, okay? Because constant product market makers requires that, product of the liquidity pools must be constant over time. Okay, and we can easily solve this equation for the amount of cash this guy must pay, and if you divide it by the amount of token this guy finds, you will get the price. So it's quite easy, right? So and it's completely different from the traditional limit order system where the price is determined by bid and ask quotes, and the traders are trading with each other. But here in the automated market, traders are trading against liquidity pools, and the price will be automatically determined by this kind of very simple function. So they're different, but they coexist. So we want to know what's going to happen when they coexist. And of course, we have several papers on automated market makers or decentralized exchange in general. But the point is, they do not, they assume that centralized exchange is exogenously given, or price on the centralized exchange is exogenously given. So traders have no choice when they decide on the trading platform. But we generalize these points, so we're going to have endogenous CX price, and also traders going to decide on the platform in endogenous. And here is sort of summary of the key findings. So in the first part, thank you, much better. So in the first part, we are going to analyze how traders are going to decide on their trading platform given, or maybe if there's some exogenous variation in a DX liquidity. And an interesting result here is that we find that informed traders and noise traders, they're going to exhibit sort of the different reaction to the DX liquidity fluctuation. And because their trading behavior determines the noise to signal or signal to noise ratio on a CX, it is going to affect the CX liquidity as well, or bid-ask spread on a CX. Okay, and also even if you look at only the informed traders, we find that informed buyers and informed sellers will exhibit different reaction. If you got some material news and if you're buying, then you're more likely to trade on CX. If you're selling, you're more likely to trade on DX. So this is going to make informativeness of buy order and sell order on both exchange platforms sort of asymmetric. And also bid-ask spread, bid-ask price will be asymmetrically distributed around the the expected value of the asset. So there are kind of testable implication of our theoretical model. And in the second part, we endogenize DX liquidity. Okay, so in the equilibrium, DX liquidity and CX liquidity will be jointly determined, and conduct some numerical and also sort of the comparative statistics. And I guess the one interesting result here is that we find that DX liquidity exhibits sort of ambiguous reactions to the asset volatility. And this is kind of new because all existing papers argues that DX liquidity always negatively reacts to the asset volatility. Okay, in my model, in our model, it depends on the parameter values. Of course, we have some parameter regions that DX liquidity negatively reacts, while in some other parameter regions, DX liquidity supply increases due to the asset volatility. Okay, so let me show you the model. So it's very simple. We just kind of have just one asset whose initial value is equal to 1. Okay, and again, we're going to think about the trade of cash and asset, but you can also think of it as the trade of two digital tokens, in which case the value is just a relative value and the price will be just the exchange rate. Okay, so in the first period, the market makers, competitively market makers, going to provide liquidity both on the centralized limit order market and a decentralized automated market. In the second period, some shock hits and generates liquidity taking orders. With probability eta, the shock is going to hit the common value of the asset, okay? And with the same probability, the asset value increases or decreases by sigma. So you can think of the sigma as the asset volatility. And in this case, or in these cases, there are some traders who know the realized value of the shock, and in order to make profit, they're going to trade. So they are informed traders. With the complementary probability 1 minus eta, shock is not going to hit the common value of the asset, but it's going to hit the private value of trading of noise traders. So they're sort of the exogenous random guys. So they're trading because of exogenous trading reasons like hedging motifs or margin constraints or borrowing or lending requirements. Okay? So those kind of exogenous random reasons are summarized by noise trading. And after this kind of liquidity taking orders, information about the asset value becomes public, and the market maker on CX leave price or limit order. And if there is some close market arbitrage, some arbitrage traders can arrive at the market and make transactions in order to make profit. So this kind of summary of the model. I mean, this start point is not that important. We are at this point in order to make the model consistent with the sort of the real world. So our focus is going to be informed traders, noise traders, their platform choice, as well as liquidity provision. Informed traders. So they're going to be buying or selling the 1 unit of asset, knowing the realized value of the shock. And upon arriving at the market, they're going to compare the marginal trading cost between these two platforms. Okay. And the fraction, we denote the fraction of informed traders buying the asset in the case of positive shock on a DX by this beta buy. Okay. And a beta sell is a fraction of the informed sellers selling on a DX in a case of negative shock. And they could be different because of the kind of convex pricing curve. Noise traders, as I said, they are just a random guys. So randomly buying and selling with the same probability, and they are trading some exogenous Z unit of asset. And here we assume that those noise traders are kind of unsophisticated, small, like retail investors, like you and me. Okay, so maintaining a multiple trading accounts on both exchange platforms are kind of costly. So we assume that they're going to decide on their trading platform before they enter the market. And here, alpha fraction will be trading on the decentralized exchange. But this last point can be relaxed, and we got the same numerical result. Okay, so here is sort of the kind of schematic view. So informed traders and noise traders, they're going to be differentiated between limit order market and automated market. And on the limit order market, so this structure is actually same as the traditional Gross-Milgrom type argument. So market maker is going to positive break even bid-ask spread, and we know that bid price and ask price, they're going to be the function of how much informed traders are trading compared to the noise traders, signal to noise ratio. Okay, and if the adverse selection gets worse, then market maker is going to charge wider bid-ask spread, making the CX less liquid. Okay, it's kind of standard Gross-Milgrom type argument. Then what will be the price on the automated market? So as I said, to begin with, the market maker is going to inject some asset, some amount of asset. And once you decide on this assets, the amount of asset you're going to inject, the automated market maker is going to pin down the amount of cash you have to provide. Okay, so this kind of market making liquidity provision decision will be characterized by this X0 only. Okay, so you guys gonna provide asset, but why? So by providing liquidity, you're going to get some return. And the return comes from the changes in the liquidity pool due to the trade and trade execution fees. Okay. And the price is going to be determined by the constant function market makers, which is characterized by this function F. This is kind of general form of automated market makers. So initially we had this, X0 and C0. This is the initial state of the liquidity pools. After the trade, we are going to have this one. And some function of this liquidity pool state must be constant before and after the trade. This is the kind of requirement imposed by the automated market maker. For example, as I said, this is kind of general form. We are not going to specify, provide a specific functional form. We're just going to assume that this F generates convex bonding curve. But this is general. For example, like if you want to talk about the constant product market maker that I gave you, you can just assume that this function F is the product. Okay? It's kind of general functional form. And by playing with this kind of function, we can find that the marginal price trading cost on a decentralized exchange is an increasing function and also convex function of the trading size, delta. And also, this is a decreasing function of the size of the liquidity pool. If and only if you are buying the asset. When you're selling, the price is going to be an increasing function of the H0. And I guess the important thing here is that we can also say that the price impact is going to be a decreasing function of the size of the liquidity pools. So the larger the size of the liquidity pool, the weaker price impact you're going to incur. Okay, I already showed this. All right, so we pin down the price on a centralized limit order market, and also we pin down the prices on a decentralized automated market. We also have to incorporate some fees, okay, and they're going to be differentiated between these two. Okay, so as I said, first, I analyze how traders going to decide on their trading platform given liquidity on a DX. Informed traders, they are concerned about the liquidity on a DX. Why? So basically, we know that informed traders tend to cluster on the same side of the market because they are trading based on the same information, right? If there's a positive news, you guys are going to be buying the asset. And this kind of informed traders' behavior generates relatively large shift in the liquidity pools, meaning that each informed trader is going to incur relatively large pricing. So that's why they're concerned about liquidity on a DX. But in contrast, noise traders, they're not really concerned about liquidity because, as I said, noise traders are random guys. So random buy and random sell order tends to cancel out due to the low large number. So the liquidity on a DX will not change that much, and each noise trader will incur only a limited price impact. So that's why they are not really concerned about liquidity on DX. This difference between informed trader and noise trader generates this kind of impact of DX liquidity fluctuation. So if DX liquidity goes up, say exogenously goes up, this is going to mitigate the price impact on DX. Informed traders, they are very happy about it because they can enjoy this reduction in the price impact. But noise trader, they're not really happy because, actually they're not really care about this because, noise traders face limited price impact to begin with. So even if there's a DX liquidity improvement and a reduction in the price impact, they're not really, affected by this kind of stuff. And because of this difference, first, informed traders, they're more likely to trade on a DX, meaning that adverse selection on a centralized exchange is mitigated, okay? Bid-ask spread shrinks, and this is going to make CX kind of less costly for noise traders. So noise traders want to move to the centralized exchange, and this is going to mitigate adverse selection even more, and a CX liquidity increase. Okay, so we can say that DX liquidity is going to have positive spillover effect on centralized exchange liquidity. And this is going to be very useful when we talk about endogenous liquidity on a DX. So in order to analyze the endogenous liquidity provision on DX, we have to pin down the profit function of market makers on DX, which comes from, it's kind of similar to the traditional, limit order market discussion. It's going to be coming from informed trading and noise trading. If informed traders are arriving at the market, then they're going to impose some adverse selection cost because informed traders are always, taking kind of more variable asset by adding less variable asset to the liquidity pools. So whenever informed trader comes, then the value of the liquidity pools will decline, and the market maker gets kind of reluctant to supply liquidity. In contrast, if noise trader arrives, again, they are trading randomly. So in expectation, they will not change the state of the liquidity pool. But noise trader is going to pay trade execution fees. Okay, noise buyers and noise sellers, both of them will pay this fee. So the market maker is going to get this positive return. So the result, the market maker's profit on DX will be characterized by this red one, which is the informed trading, what we call impermanent loss, or maybe the adverse selection cost, and the profit from fee that emanates from this noise trading. Okay? And both are characterized by this initial size of the liquidity pool. Okay. And analytically, we can find that this function, profit function, is a monotonically decreasing function of the liquidity supply because we know that when liquidity improves on a DX, more informed traders want to trade on a DX, while noise trader try to avoid DX. Okay, so this is going to increase this red part while this blue part declines. So the market maker's profit, declines. So we're going to have this kind of monotonically decreasing function, and we find that there is some unique break-even point. Okay, at this point, each market maker is indifferent between supplying and not supplying liquidity. And because this curve is going below from crossing this x-axis from above, this x0 star is stable liquidity. And given this liquidity, so to say, endogenous DX liquidity, we conduct some numerical experiment. So here, here's a comparative statistics regarding the asset's volatility. So we want to know what's going to happen to the equilibrium variable when you increase the volatility of the asset. Okay, so here, x-axis is sigma, which is the asset's volatility, and I plot some equilibrium variables. And I guess the most interesting thing is this one, this ambiguous reaction of DX liquidity. Okay, so of course it depends on the parameter values. So if you are somewhere around here, I mean the ether is point something, 0.3 or something, we only have this kind of monotonically decreasing reaction. But in some other parameter regions, it is possible that DX liquidity improves due to asset volatility. Okay. Okay, and here I changed the value of eta, which is the frequency of the common value shock. But we find that this result is quite robust. Even if you change the value of other parameters, we still have this kind of ambiguous reaction of DX liquidity. Why? Why we have this kind of ambiguous reaction? So as I said, literature suggests that when asset becomes more volatile, this is going to increase the impermanent loss. Or I should say, adverse selection cost for DX market maker actually gets worse. Okay. And because of that, the market making profit declines and the market makers get reluctant to supply liquidity. So X star is a decreasing function of sigma. So this is what the existing literature suggests. But in our model, we have the second competing channel. If asset becomes more volatile, we know that bid-ask spread on a centralized exchange also gets wider. Okay, adverse selection on CX also gets worse, so the market maker is going to charge wider bid-ask spread. And because of this, wider bid-ask spread, both noise traders and informed traders on the centralized exchange try to escape from the centralized exchange to the decentralized exchange. Okay, but informed traders tend to dislike, so they are concerned about, informed traders are concerned about clustering on a decentralized exchange, while noise traders, they're not concerned about this kind of clustering. So it is easier for noise traders to move to decentralized exchange compared to the informed traders, meaning that this is going to give market makers an additional profit opportunity. So the market makers on the DX, are willing to provide additional liquidity. Okay. So because of this kind of two competing effects, we have this kind of ambiguous reaction. And of course, the second channel is unique to our model because if you have only CX, we don't have this, second channel. Or maybe if you assume that trading platform choice is exogenous, then we will not have these 3 breakpoints. Okay, so only if the CX price is endogenous and traders platform choice is endogenous, we're going to have this competing effect generating ambiguous reaction. Okay, and seems like I'm running out of time, so let me just briefly mention this one. So we know that automated market making system is convex pricing. Okay, so even if you're trading same size of the asset, if you are buying the asset, you're going to generate relatively large shift in the cash compared to the case that you are selling the asset. Okay, so because of this kind of difference, buying 1 unit of asset incurs relatively large price impact compared to the selling 1 unit of asset. Okay, so the informed sellers tend to trade on the DX compared to the informed buyer. And this is going to generate asymmetric bid and ask, or should I say like a bid ask midpoint is going to be biased toward above the upward, I should say. And also because of this kind of inequality, we can say that informativeness of the buy on a sell order on both exchange platforms will be kind of asymmetric. Okay, so here's the conclusion. So decentralized exchange, proposing kind of new market making structure, automated market makers, and we provide a theoretical framework that analyzes the coexisting DX automated market and centralized limit market. And because of this kind of endogenous CX as well as endogenous platform choice by traders, we can provide some kind of novel implications. Okay, I think, is it just time? Okay, thanks so much.
Thank you.
Hi, so my name is Katya Malinova. Thank you very much to the organizers for having me. Lesson of the day, do not use Internet Explorer. Chrome, much better, it works. Hopefully the remote works too, or I have to press on it, right? There. So before I get to the paper specifically, we're talking about decentralized exchanges. And just to bring everybody to the same page, why is it so important that we understand how they work? What's special about them? Well, we got to blockchain. So we're talking about transfers of value. When we're talking about transfers of value, the natural question that comes to mind is, let's trade. How can we trade on it? The blockchain is an infrastructure, and it's not a marketplace. And so it's not obvious how to move from value transfers to actually trading. So the first natural step is to say, okay, let's do a limit order book. But as Jun mentioned, limit order book comes with challenges. You have to monitor, quote, reprice, many gas fees. Every node has to update to the new limit orders. So does not work very well on the blockchain. And here comes this, you can also do it on a centralized exchange. But a centralized exchange comes with its own challenges. In the worst case scenario, you have a beautiful infrastructure, blockchain, you put a laptop and a human on top, and a laptop that may fail and a human that may run away. So that defeats the entire purpose. And even in the best case scenario, it seems that you're missing out on actually using the infrastructure. So there comes this new brilliant idea, decentralized exchanges, and let's pool liquidity and let's just have an automated prices and automated market making. And when I first read about it, and coming from a microstructure background, it's like, this is never going to work. It's just, you have a random function that is just preset, never going to work. Surprisingly, after I've read several papers and several empirical papers, including from the people in this audience, it works, and it works quite well. And it actually matches the prices similarly on the centralized exchanges, and there's arbitrage going on between the two exchanges. And so the system does seem to work. So we really need to understand it. On top of that, the system is huge. And so this is not probably quite representative because I pulled it yesterday and we're sort of in the middle of, don't want to say crisis, the interesting times, put it this way. But it's $8 billion trading volume on the DEXs, and it's huge. In the fall, it was $12 billion. So how you put it, it's a large trading volume. So what do we have? We have a genuinely novel market institution. We need to understand how it works. At least I think from a finance perspective, we really need to understand how it works and how does it interact with the existing ones. And maybe, so at the moment, yeah, we're trading crypto assets on it, but maybe we want to move the main finance infrastructure because face it, the settlement infrastructure in the mainstream finance and lots of things just don't quite work. So can we use it? Can it become more mainstream? What issues should we think about? And how does it interact with central exchanges? And the general topic of sort of coexistence of exchanges has been around late 1900s. Does that sound old to you? Actually, the papers don't sound that old, but it has been around for a long time. So Marco Pagano, 1989, trading volume and asset liquidity, and basically says that it's kind of a knife-edge cases when exchanges coexist. All traders tend to cluster. So empirically, yeah, there are different market structures, plenty of them. Theoretically, it's actually not as straightforward. And so there are several papers, and several are listed here. I glossed them. Is the electronic limit order book inevitable? Yes, the answer is yes, but in the paper, and yet we have, again, so many different market structures. Back and Baruch basically say that, well, yeah, it's not inevitable, but if there are different pricing structures, you're going to basically have equivalent equilibrium. So how do we get this coexistence from a theoretical? What's special? And so I think it's an interesting question to explore theoretically. It's an interesting question to explore empirically. There's also a paper on do dark pools harm price liquidity, which by Haoshang Zhu, which seems quite closely related, right? Because we're talking about liquidity pools versus central limit order book. And he finds also some clustering exists in those markets, so informed tend to gravitate to the centralized exchange. So when it comes to the decentralized versus centralized exchanges in crypto markets, though, it's much more than that. And so the question is actually much more interesting and much more exciting, because we're not just talking about differences in the pricing structure. We're talking about a host of other differences. So there are settlement different arrangements for settlement. If you're trading on decentralized exchanges, you can use those tokens in a variety of DeFi applications. You can't do that when you trade on centralized exchanges. So possibly these tokens may have different values. There's a whole host of new players that come in. So there are validators to think about and their incentives to think about. And I'll defer this to the next paper in the session that we'll hear much more about. And there are coexisting markets there as well. So an extremely interesting topic. There are already several papers that are there in this area, and again, several of the authors are present here. Agostino and Ruggi compare the welfare of liquidity providers on the DEXs and sort of look at the liquidity providers, liquidity freezes, liquidity breakdowns on the decentralized exchanges. There's Alfred and Christine's paper where they compare these two markets in isolation. So there is Andreas's paper who compares different markets, different pricing properties, and different desired pricing properties. So this paper talks about coexistence. So when we have about coexistence, again, there are different things that you can focus on. The authors focus on the pricing rule and the novel pricing on the decentralized exchanges. And they have several results. So the equilibrium exists, the empirical predictions that there is an asymmetric impact on the buy and sell, and there are complementarities in liquidity for the decentralized and centralized exchanges. So I have several general comments and sort of some model comments. In terms of general comments, I would like to see this paper to be more grounded and more related to the existing literature, because it is a large literature in finance on coexistence of exchanges. And also, when we're talking about existing literature, many of the papers find multiple equilibria and possibly equilibria where the trade concentrates on a single exchange. So here the authors focus on the one where exchanges do coexist. Now, what happens when they don't? And are there equilibria when they don't? And which one is sort of more covers the larger range of the parameters? More generally, other pricing differences, are they the key? And this is probably not for this paper, but I think this is something we need to understand. Is that the key for the coexistence, or are there other issues like maybe the use differences? Model-wise, and I may not get to this when I'm talking about the model, but the limit order book on the centralized exchange here is quite stylized. So there is just a single level of the order book. There is no repricing in progress by the market makers. Limit order book is not discriminatory. How critical is this? So effectively, there is no price impact. Informed traders come and hit the limit book order book like a train. And until the train ends, the market makers on the limit order book in the model do not recognize that the train has just come through the station. So how critical is that for, and yet there is a price impact on the DEX. So I think I'd like to know a little bit more about that. And then are there any implications on price discovery? Because we're talking about informed traders. Now, in terms of the model, so to recap the model, there are 4 players, but really the 3 are the ones that are important. There are liquidity providers that post on centralized exchanges, decentralized exchanges, provide liquidity on decentralized exchanges. There are informed liquidity demanders that only come when there is information. They're perfectly informed and they all trade in the same direction. So again, if there is information, everybody, if it's a good news, everybody's buying. If it's bad news, everybody's selling. Then there are noise traders, and there is a continuum of noise traders, and they trade 50-50. So when the noise traders come, you just kind of have wish, and the train hasn't left the station at all. So there's zero order imbalance, and that also implies that there's no price impact on the decentralized exchange at all. It's not noticeable on the decentralized exchange. And period 3 just kind of clears the market back to the new value in case the value has changed. So period 3, as Jun said, is really not important. And I would say just drop it. just say market equilibrates. Because it took me, I was hoping for something arbitrage. What do they do? They actually don't do very much in the model, except they just kind of trade to the equilibrium, but it's not the part of the model. Now, the way and how do we trade? So we can trade on the centralized exchange, just Binance, one example. Have a limit order book, but again, it's not discriminatory. So liquidity demanders all enter sequentially, but they all pay the same ask price. There is no price impact cost from here. So if you're too late to the game, you pay the exact same price as the earlier entrants. Nobody kind of, you just, we're all lining up and we all pay the same price. No walking through the book. What's the cost? It's the same cost for informed and noise traders. Everybody pays the bid-ask spread. Then there's the decentralized exchange. So the price is determined by a bonding curve. And just as Jun showed in the graph, it's discriminatory. So if you're late to the game, the price has moved from under your feet. And if you're buying, the price is really high. So basically, it's low when you come first. But if you're slow, have your coffee in the morning, that's it. It's gone. What's the cost? Well, informed traders are going to face the price impact cost, and everybody's going to pay the transaction cost. And this transaction cost is in terms of the asset, and it depends on the trader's asset valuation. And so this is the part that I'm going to return to. So it's not actually the same for all traders, as it turns out. Now, informed traders, why do we have coexistence here? Well, informed traders could go to the centralized exchange, pay a flat bid-ask spread. Or they can go to the decentralized exchange, in which case they incur flat transaction cost, plus the marginal price, which is increasing because of the price impact. So flat versus something that's increasing, there is a point at which you're indifferent. So if you're thinking about it dynamically, and the model is static, but if you're thinking about it dynamically, I'm going to run to the DEX up until the price there hits the Binance price, at which point, if I'm too late, I'm just going to go to Binance and clean the market makers, like there's no tomorrow. So informed are fairly clear. Uninformed, at least fairly clear in the model because the flat cost of the Binance. Again, they pay the flat bid-ask spread on Binance, but on Uniswap, they face no price impact whatsoever because of the flat, because of the balancing out. But transaction cost increases in the noise trader valuation there. And the noise traders have heterogeneous valuations. And this is where I'm kind of questioning, why do you have heterogeneous valuations? It seems like a complicated feature of the model. And again, they're going to trade because the transaction cost differs across different traders. Some of them are going to go to the centralized, and some of them are going to go to the decentralized exchange. And so this is why I'm wondering if a difference that does not exist in the traditional models, but that is actually apparent in the DeFi world. Maybe we can play with that assumption and say, well, it's different values, because when I come to this centralized exchange, I have one slide left. When I come to the decentralized exchange, I trade for a different reason, potentially. I want these tokens because I want them to use them in DeFi applications. I want synthetic tokens because I want to use synthetics. I might be liquidating something and make a DAO. I want to trade on the DEX. So because it's the use value, arguably maybe there are more noise traders. I'm not sure, but maybe there are some traders that are just stuck on the DEXs. Some noise traders. So there might be some other assumptions, and maybe it does play an important role for why we split. So my final comment is on the liquidity providers. And so this is where I'm not sure. I was kind of circling back to the knife edge coexistence from the traditional literature. And here, if I'm a liquidity provider, I'm making zero profits on the limiter book. And I'm kind of either making money or losing money on the decentralized exchanges. Well, there is a pool size that equilibrates it all, but it's a lot of things that need to come together in order for this to be all in equilibrium. And so the question is how robust is that, and how does it work? And so then this is my the last comment: why only one limit on a book, or why only one level, and to what extent does it matter? Because if I'm there early on, I'm good. But if I'm late in the queue, I only got to trade if the entire train of informed traders came through the station and hit me. Bottom line, an extremely important question, a very interesting paper. And thank you once again to the organizers. And thank you for giving me an extra minute.